Welcome to Oaktree's Insights Live. I'm Danielle Poli, head of Oaktree's Product Specialist Group. Today I'm joined by Bruce Karsh, Oaktree's co-chairman and CIO, and Armen Panossian, Oaktree's head of performing credit. Today we'll be discussing key themes in the fourth quarter of 2021 and looking forward what may lie ahead in 2022. Thank you, Bruce and Armen, for joining me. I'm going to jump right in with an observation about the fourth quarter of 2021. It was a bit tumultuous. November saw some weakness, December a big rally, a couple themes that have persisted, an uneven recovery around COVID and an uncertain inflationary environment. Bruce, an important question for you. What's on your mind as we start 2022?
Well, what's on my mind is what's on the mind of the Federal Reserve. I think that's the most important question right now. We know that they were concerned enough about inflation that they decided to accelerate the taper. We understand from the minutes that some of them are concerned enough that they might even accelerate the interest rate rises and potentially reduce the balance sheet, so-called quantitative tightening. So the real question is, what are they going to do and when are they going to do it? And I think that really is going to turn on the inflationary outlook and what data comes out about how serious a problem we have on the inflation front.
Armen, any thoughts around that and what it could mean for the next few months?
I think we could expect to see more volatility, probably to the downside, as it pertains to rates and as it pertains to credit quality in the back half of 2021. We saw some pretty nice year-over-year comparisons in companies that were recovering from COVID. We did see a more stable reopening happening for much of the early part of the second half of the year. And so there is a little bit of concern in the back of my mind that will 2022 year-over-year comparisons look quite as meaningful to the upside? And if they're not, then we have both a rate-oriented risk issue in asset prices, and we may have a credit-oriented issue in asset prices because investors, whether they're equity or debt investors, do look at growth, do look at year-over-year comparisons. And if we do see some unevenness around the reopening, or if we just see muted growth, or if we do see the impact of inflation causing higher costs but not higher revenues, there's a lot that could come into impacting equity markets and debt capital markets.
I think the rate-oriented issues that Armen spoke about are very real. And we're already beginning to see that in the first 2 weeks in January. And the equity markets are reflecting it as we speak. I think credit is going to hold up much better. I don't think there's a particularly good prospect of a downturn or a recession in 2022. I think it's a low likelihood, possible, but pretty low likelihood. We're coming in with a fair amount of strength in the economy right now. So I think credit will hold up reasonably well. There may be some spread widening, which will impact prices to some extent, but the discrepancy between equity performance, which could be seriously negative, versus leveraged loan or high yield bond performance will be striking or could be striking this year.
Yeah, and actually, if you look at the first 2 weeks of this year and you look at fixed income assets, the highest duration assets, so investment grade, and then the longer duration high yield bonds are the ones that are taking it on the chin to a greater degree than the average in either of those two.
And did last year. In 2021, treasuries were negative. Investment grade security performance was negative. And yet high yield and leveraged loans held up very nicely.
Sure.
And I think that trend could well continue into this year, particularly on the leveraged loan side, which we know is floating rate, and I think has been attracting a lot of investor capital.
Armen, what you mentioned about longer duration assets right now, taking it on the chin, could this create potential opportunity for investment later on this year?
Absolutely. Anytime fixed rate assets are trading at a discount to their call price or to par, it can create an opportunity for an attractive total return. If you take the view that a recovery could occur prior to the maturity of those bonds, I think there's a very attractive opportunity for patient investors that have good bottoms-up underwriting, that have tracked certain companies and certain industries through cycles, and really picking the right time to add exposure, understanding that it may continue to fall, but that falling knife could really generate some attractive returns through a cycle.
Mm-hmm. Now, Bruce, I gather that floating rate assets you find more attractive than fixed rate assets. Where do you think the best relative value lies today?
I think on the real estate side, real estate debt securities that are floating rate provide attractive spreads, as much or more than high yield, which are fixed rate. And I also think that double B tranches of CLOs are interesting because the spreads there are very high, over 700 basis points above treasuries, and
defaults are expected to remain so low.
I think that's right. I think that's the key. And there may be some volatility because there always seems to be when equities go down a lot, CLO tranches go down, but this time might be different. The capital markets had been so wide open and generous over the last year or two that most companies took the opportunity to really push out their maturities. And interest rates still are low. They're going up a little bit, but on an absolute basis, still very low. So you have companies that probably won't default. So as a consequence, I think that double B CLO tranches, which are ultimate recovery, are going to be very dependent on default rates, should perform reasonably well.
A final question for you both. Are there any risks or opportunities that may be underappreciated by the market today that you think could have possibly a big impact?
We've got midterm elections coming up this year. We've got some actors out there like Russia and Iran that I think there could be some real issues, some hot spots that arise that we don't think about or talk about very much that could have a significant impact on commodity prices or just psychology general or Western Europe.
Yeah, to that laundry list, I'd also add China. A potential slowdown in the growth rate of China or the Chinese economic recovery is potential global risk. It could impact commodity prices globally. So there are opportunities there. There's also risks that if you do try to get into some of these situations that are have potential for downside, if we're in the first or second inning of what may be a very long ball game, being early in those situations could prove to be a big risk.
Well said. Bruce, what's your mantra for 2022?
The mantra for 2022 is watch the Fed carefully, watch inflation carefully, and I think it's clear that 2022 is going to be much tougher than 2021, and maybe even more so than 2020 in terms of performance in the capital markets. So I think as the cycle is progressing, it seems to be progressing relatively quickly, much more so than earlier cycles, and that's just the unique nature of this one, where there was so much firepower thrown into the global economy at one time. And 2022 is the year in which the central banks around the world really want to take it back and try to cool down what they see as an inflationary environment that's potentially very dangerous. So before, I think we were swimming with the tide. Now we are heading into some headwinds, I suppose, that are going to be something that we'll have to navigate very carefully.
Well, thank you both so much for our conversation today. 2021 was certainly memorable, and no doubt 2022 will be as well. We look forward to navigating the new normal and seeing you all again soon. Thank you.